Hi everybody, welcome to the final quarterly returns update. In this video, we're going to go over the returns of capital markets in the last fourth quarter here of 2022, covering stocks, as well as bond and treasury markets, and a few other key areas, as well as we'll go over my thoughts of these areas going into 2023, and then we'll also discuss the returns of my own portfolio, as well as the positioning of my portfolio for the beginning of this next year. If you're new to the channel, you can catch previous return updates that I have in a playlist listed down below, as well as you can catch the valuation live streams that we do each Tuesday, covering discounted cash flows of various companies in the stock market. Before we get into today's video, please give the video a like and subscribe to the channel if you're not already, and also you can join the Discord, the link to which will be found in the description below. All right, so starting with the treasury returns, in some of the previous videos that I had on this channel of the return updates, I actually had a mistake going on in the calculation of the annualized returns for the treasuries that I was having there. There was a problem with the duration part of the calculation. So in previous videos, I actually had the returns for the treasuries a little mistaken, but I do believe I have them correct now. As you can see, the tips was the obvious outperformer, being up not quite 10%, but like 7 to 8% or so, with 3 months being the outperformer of the main non-inflation adjusted treasury returns, and the 10-year treasury performing the worst, obviously with the increase in yields that we can see on the right hand side there. Huge increase in yields across the board, but because of the fact that the 10-year is the largest duration, the increase in yield had the largest effect on them in terms of return. Switching over to the corporate bond markets, we can see that the corporate yields have also moved upward pretty dramatically throughout the year, both in investment grade treasuries, as well as high yield emerging market investment grade, as well as emerging market high yield. Obviously a pretty consistent trend upward for each of them, and then the returns for each of them is pretty consistently downward, much in line with the treasury yields, though you can see that at the end of the year, pretty much all four categories end up within only a couple of percentage points of difference, even though there was a pretty large discrepancy throughout the major part of the year, especially as you can see the emerging market high yield corporates performed the worst throughout the midpoints of the year, reaching a serious low point in October before having an entire bull market up almost 25, I believe, percent since that point. So who knows, maybe they'll retrace back to the bottom with the large volatility that we've seen, but it could be that people who grabbed emerging bonds at that bottom there have already grabbed the bottom for that particular point of the cycle. And switching over to the currency markets, we obviously, the main topic of the year in terms of currency has been the outperformance of the US dollar and King dollar, as we are calling it right here. The 10-year treasury return that we've kind of already talked about being down pretty significantly, but the domestic market government bonds outside of the US have performed even worse than that. And on the whole, emerging market government bonds have actually outperformed the US bonds, which has somewhat to do with that large volatility in relation to the yield change of emerging markets that we already saw. They were performing worse at some points, but because of that same bottoming in October and the rebound since then, they've actually gone a little bit ahead of the dollar in terms of the overall return. And then the currency returns on the flat of it, the actual exchange currency, which is the right hand chart there, as you can see, the US dollar index massively outperformed. And it's worth noting the list of the other currencies that I have listed there: the Canadian dollar, as well as the euro, the pound, the Australian dollar, and the Swiss franc. Those are not necessarily a representative sample of currencies. Those are just currencies that I'm particularly interested in. You'll note that there's actually no Asian currencies listed there, which do make up a pretty significant portion of the currency markets. And switching over to this chart, which I like to take a look at, the debt premium stack, as I call it, which takes together varying types of bond yields throughout the market and then strips them apart to get an idea of different premiums underlaid within, giving an idea of different sections of risk that exist within the debt market. I'm starting with the real risk-free rate, which is effectively the 10-year treasury subtracting out the inflation adjusted expected performance portion of it that comes from the TIPS yield, getting a portion of the bond yield that is effectively seen as the inflation adjusted real risk premium for lending. And then on top of that, we add the expected inflation, which ends up being about 2.5%. And then on top of that, we add the time premium, which normally would be a positive number, but for pretty much since the midpoint of this year, it's been in negative territory, which is what people typically refer to as the inverted yield curve. And it's been pretty consistently negative since the midpoint of the year, which is usually an indication of future potential recessions, because it shows that people are buying up further out treasury securities more than they are short-term treasury securities, showing that they see higher risk in the short term than in the long term. And on top of that, we add a low risk premium based off of investment grade bonds, high risk premium, and then an emerging premium. But the overall trend that I want to kind of point out, that ever since the mid point of the year, is that really the premiums have been in kind of steady state since about the mid point of the year, or maybe towards the third quarter for a few of the yield stacks here, as we can see here. But overall, it seems as though the debt markets have kind of leveled up. Leveled off at these kind of high points of these premiums. Maybe they'll start to pull back in 2023, or perhaps they'll push further upward if the yields continue to rise with the Fed's movements. And switching over to commodity markets, that's also been a pretty vibrant discussion in 2022. What with the hot activity caused by the invasion of Ukraine by Russia, there was large spikes in the commodity markets due to the disruption that caused. Not to mention, we were already experiencing some significant commodity and price inflation due to the coming back online of the economy post COVID. But either way, you can see especially the big outperformer was natural gas for most of the year, stretching pretty high up there, and then retracing at various points, being very volatile throughout the midpoints of the year. By the end of the year, it's actually down pretty significantly back into into at least a pretty moderate range, with the rest of the commodities still up pretty dramatically overall on a yearly basis. And then other major outperformers for most of the year were oil, as well as we had a pretty significant upward movement in just kind of the overall commodity index, and wheat prices as well. Wheat prices have come down pretty significantly as well towards the end of the year. Oil prices are almost back down exactly to where they were at the start of the year. And then the major underperformers being lumber and Bitcoin. Obviously, Bitcoin is really just included here, partially just kind of for novelty's sake. And the lumber prices, I think, is pretty interesting to see the dramatic underperformance of lumber, especially considering the massive pullback in overall mortgage activity and the real estate activity. I would say that the lower lumber price so dramatically at this point I would say give a strong indication that those markets could come back online faster than people might expect, given the low prices. And then taking a look at the overall equity markets in terms of the main benchmarks that I like to look at and kind of judge myself against. Obviously, the S&P 500 being the main one that people tend to look at, but these other four markets, I think, altogether give us a kind of overall picture of the entire equity markets across the globe. These five indexes effectively include like 99.5% of the market cap of the entire world. So I think it paints a pretty good picture of overall equity markets. Russell 2000 being representative of the small cap in the United States, and then we have developed markets and emerging market indices, which are representative of large and mid cap, and then a foreign small cap index, which it goes across both developed and emerging markets. For the developed and emerging market and foreign small cap indices, I'm using Vanguard indices as my proxies. It's worth noting. And then taking a look at this chart here, which is my kind of measures of overall derivative volatility, including both the VIX index as well as the overall equity put to call ratio. That's put to call ratio across total equities, not just the S&P 500. I use a week or 2 week moving average for that measure, since it tends to be extremely volatile. We had kind of talked about there was large spikes in the VIX at earlier points in the year, while the put to call ratio wasn't necessarily keeping up. And then, as we can see, as we moved into the later part of the years, they've kind of reversed positions as the VIX has kind of mellowed out pretty significantly throughout the later part of the year, while people have continued to buy up protection. It could be that people are actually getting a little bit too afraid, and they're buying up too many puts, and that could be a sign that we've kind of bottomed up a little bit. But it also could be an indication that the VIX, which is specifically an S&P 500 implied volatility measure, since the VIX is super low, but the put to call ratio being a total put to call ratio is up, that could indicate that there's just higher protection on the lower sections of the market rather than the larger and mid cap sections, which is where the VIX particularly plays. But that's just one particular thought I had in relation when looking at this chart. Now coming over, taking a look at the U.S. sector performances by the different sectors separated out. Obviously, throughout the entire year, the energy index was the major outperformer, as we kind of already discussed the energy commodities and how they've moved throughout the year. But it's worth noting, if you remember on that commodity chart that we were just looking at, we saw that natural gas prices had come down most of the way back to where they started at the end of the year, and oil prices were basically back to where they started at the end of the year. And yet we still have energy as a sector, the stocks of energy companies up over 50% on the year. There seems to be a huge divergence in the overall returns and expectations of commodity prices therein, and particularly in the energy sector. That's the specific sector that I'm focusing on with this discussion. But that's I would say is a big warning sign to people that are in the energy markets. Is like one of these markets is wrong. It's like either the commodity markets is wrong and oil prices are going to skyrocket, or the energy sector markets are wrong and the energy index is going to crash like hell. And then obviously taking a look at the rest of the sectors, we can see the major underperformers of the year is particularly real estate, technology, communications, and discretionary, which for the most part, those come in about as you would expect given the oncoming recessionary situation that we have. There's a couple of the outperformers not outperformers, relative outperformers, though the ones that went down not as much. There's a little bit more surprising in my opinion, such as, for example, industrials. You would maybe expect the industrials to be teetering on the edge of the recessionary concerns as well. But staples being relatively flat on the year, that's pretty much exactly what you would expect. Now switching course to discuss my own portfolio performance across both the fourth quarter, comparing it to the third quarter, and then also discussing my performance across the entire year. In the third quarter, I was down almost 11%, which was pretty unsatisfying, especially comparing it to the S&P's downward movement of about 5% at that point. And I expressed my discontent with that in that previous video. In this most recent quarter, we were up about 7.5%, just barely a hair above the S&P 500 return for the quarter, as well as I don't have it listed in the numbers here, but the S&P over for the whole year was down 18.1%, and my own portfolio was down 17.4%. So we ended up beating the S&P by about 0.5% on the year, which is, not very satisfying. It's, sure, it's beating the S&P 500, but we had a significant more amount of outperformance in the first quarter, and so the fact that we managed to lose all that outperformance over the course of the year is pretty unsatisfying. This was definitely a complicated year to deal with for pretty much anybody in the markets, and so in some senses, being able to at least keep up with the S&P is always at least satisfying when you know that there's so many other individual investors that are not. But I'm obviously trying to outperform the S&P, so I definitely always want to do much, much, much better than that. And I do think that I have done a lot of work this year, recognizing the mistakes that I made last year. There was lots of mistakes that I made last year, lots of positions that I was in at the end of the year that were basically just setting myself up for the underperformance in the mid sections of this year. Not to mention, I spent a lot of the year trying to learn new tools and tricks related to valuation as well as portfolio management, and that required a little bit of investment, so to speak, of both time and small amounts of the return being sacrificed in the short term to learn some of those details. But either way, I'm expecting to do much better moving forward. We've moved a lot of our investments around for good or for ill, as we'll kind of discuss right here. Because in one sense, you could say I was handling the soap a bit too much this year, you could argue, but I would also argue that I was required to do so based off the mistakes that I had set myself up for in 2021. It's like, yeah, I had to recognize those mistakes, sell out of bad positions, double down on the ones that are still good, and I had to buy up lots of new positions. Some of those newer positions were false starts, and I resold, and then other ones I had to kind of move in. So it just is what it is. Like I said, I'm happy considering the amount of mistakes that I made this year. I'm actually pretty happy that I managed to at least stay in line with the S&P 500 is basically the perspective I'm taking away from it. But overall, my cumulative COGR since starting investing, which is a time-weighted COGR, taking all cash inflows into account, is about 7.5% or so per year. Comparing that to the S&P 500 on a dollar comparative basis, assuming that when I deposited money, I had also invested in the S&P 500 at the same time, I would have earned about 10.75% or so comparatively. So I am underperforming by over 3% per year on that basis. So we're still significantly underperforming the S&P 500, which is what we don't like to see. But again, I think I will in the long run start to outperform over that, and that's a small enough underperformance that I'm okay with it as is. I have the expected 5-year CAGR for the S&P 500, which is the discount rate that I'm using, assuming the index is accurate today. That's not what I actually expect the S&P 500 to perform. I expect them to do worse. But the discount rate that I measure them out when I'm valuing the S&P is about a 9.5% discount rate. And the expected return of my portfolio, given that and also the valuations they're in, is about 13.6%. So that's the expected return that I have going forward on a 5-year basis. The return ratio, which is the ratio of my overall total cumulative return of my return to the S&P 500, is 0.69, which means that I've earned about 70% of the total annual returns of the S&P 500. That's a total return, not just the annual return. So that basically means if the S&P 500 had earned 100%, I have earned 70%. That's not the actual percentages, but you get the picture. So taking a look at my returns over the long run since I started investing, that's what we have right here on the left-hand chart. You can see the cumulative return of my returns. The branching off on the red to the orange is when I started actually measuring the dollar weighted cumulative return of the S&P 500, which basically means if I took my own dollars and then measured it comparative to investing the S&P 500 at the same time. So that the orange line compared to the blue line is the one that should be compared on the left-hand chart. And then on the right-hand chart is the same chart, but it's actually just the moving of the annualized rate, so to speak, which is why it moves up into pretty high levels and it comes back down to pretty low levels as the indexes move back down, which is the deep blue line is the dollar weighted CAGR versus the orange line, which is the dollar weighted CAGR of my portfolio versus the S&P. So the orange versus the blue on the right-hand side gives an estimate of the yearly return. So you can see at one point in the year, we were actually pretty close to catching up, and now we're a little bit further apart, but overall, we're still relatively close. So in my opinion, it only takes about a quarter or two for us to catch up. So breaking down my current portfolio into some of the characteristics that describes it. At the end of the third quarter, we had 23 total positions, and we're actually down to 19 positions here at the end of the fourth quarter. So as you can see, we've been shaking off some of our less confident positions, as well as selling off some of the positions that we had gains on as well. We've also increased our concentration, which is what you would expect if your portfolio positions goes from 23 to 19. There's kind of an inherent concentration going on there. But the top 5 concentration went from 29% to 31%. So really, a lot of that extra movement actually happened in the smaller positions, is what that kind of shows. The ending cash position, we had 14% ending cash at the end of the third quarter, and it's up to 17%. The average cash position during the third quarter was about 16%, and it was about 17-18% in this quarter. So I like to look at the average cash position versus the ending cash position as well, because sometimes depending on what happened in the quarter, that could be pretty significantly different. The cash target, which I also have at a pretty regular basis, 14.75% at the end of the third quarter, showing that we actually had less cash than we wanted to have at that point versus my cash target at the end of the fourth quarter. We actually have exactly pretty much on the dot the cash target, which is a little bit miraculous. That's doesn't normally happen, but just ended up that kind of way. And then my beta calculation, I do calculate a 2-year weekly return beta of my own portfolio, and I like to keep track of that pretty regularly. At the end of the third quarter, it was a 0.7, and then it's actually upticked a little bit to 0.72 at the end of the fourth quarter. Now taking a look lastly at some of the other details of my portfolio, some of the major positions of my portfolio, I like to talk about the top 5 positions and how they've changed over time. Now when I talk about my top 5 positions, I mean the top 5 positions given the cost weight of my portfolio. That's how I like to think about my top positions, is how much money have I actually put into the position, not what is its weight given the market weight at any given moment in time. So right here, we have my number 1 position, which in the third quarter was Fidelity National Financial. And in the fourth quarter, it is still Fidelity. It hasn't really changed. The overall portfolio weight hasn't really changed that much. The overall return hasn't really changed that much. My expected return, I have pulled back a little bit, just being a little bit more conservative as we move towards more recessionary concerns, trying to kind of peel back those assumptions and make sure that we still have a relatively conservative value in play here. And then also for my second position in the third quarter was Corsair Gaming. Now in the fourth quarter here is actually Smith & Wesson, the firearms manufacturer. The Smith & Wesson is up to about 6% of my total portfolio. It's actually grown pretty rapidly in this quarter. My total return on it is down about 29%, so we are down pretty significantly. We've been buying it as it's been dropping like a rock. And you can see that I was actually down pretty significantly on Corsair as well, which I'm still down pretty significantly on Corsair. I did the fact that the position has changed isn't because I sold out of Corsair or anything like that. I don't think I've sold a single share of Corsair at all during that time frame. However, it's really just that I bought up a lot of Smith & Wesson. Expected returns for both of them are up pretty significantly, but either way, I guess I think Smith & Wesson is a better position in terms of overall value. Corsair is definitely one of the companies that I would recognize as one of the mistakes I made in 2021 in terms of having bought it definitely so high. So that is what it is. Now taking a look at the third position, which in the third quarter was Sandfire Resources, another company that has been switched out, but not because we sold any of Sandfire Resources or anything like that. There's just been movements in the overall positions at hand. The new third position is in fact Corsair Gaming. So Corsair dropped from the second to third. As I said, I didn't sell any shares, so it's really just kind of been a small readjustment based off of the movements of other positions. And as I had kind of said, we were down like 55%, 56% or something like that in Corsair. Now we're down 43, 44%. So we've come up a little bit, but not up too much. And also my expected returns for Corsair has dropped. I think it was over 20% before, so now we've dropped it down to 15 to 16%. We've definitely peeled back those assumptions, and the portfolio weight is down to 4.4% or so. Taking a look at our fourth position, which in the third quarter was Turtle Beach. It still is Turtle Beach. The portfolio weight hasn't really changed that much. The return has improved a little bit, but not that much. And then we've also pulled back our assumptions on that one as well. You can see the overall trend. We've been pulling back our return assumptions on pretty much everything. And then last, our number 5 position, which in the third quarter was Smith & Wesson. As we kind of already discussed, Smith & Wesson has jumped up to our number 2 position, so it grew pretty dramatically upward at that rate. And now our number 5 position is Sandfire Resources, which was our number 3 position before. I haven't sold any of Sandfire Resources. It's really just the other positions moving up ahead of it. With Sandfire Resources, which makes up almost 6% of our portfolio. And I'm pretty sure on the previous quarter, we had seen that it was down like 30, 35% or something like that. Now it's only down about 18%. So it's actually come up pretty significantly since then. Expected returns has come down with that movement upward, and now down to about 15 to 16%. Now, so to take a look at the overall of our actual portfolio, which based off of cost weight, as I was just saying here, this is my total portfolio listed in order of those positions, as you can kind of see with our number 1 position there in green, the Fidelity National Financial. The only one that's kind of slightly off of the pattern is the one right next to it, which is F&G, which is a recent spinoff from Fidelity National Financial, which is why I have it right next to it, so that I can kind of see the two positions together. But once I have an actual separated out F&G DCF spreadsheet, I'll probably have it separated down in as a lower point in the pie, since it is in fact the smallest position I have. And then you can see the other positions I have past the number 5 position of Sandfire Resources, number 6 being Interfor Forest, then Meta, Tyson Foods, Intel, Hibbett, Barrick Gold, Buckle. You can see basically the rest of my positions. Not every slice is labeled, so if you are wondering if there's a company I have that's not listed here, it's possible it's just one of the unlabeled slices, because the slicing labeling is done automatically by Google Sheets. But this is the overall weight of my portfolio. You can see I also have about 12 to 13% in actual cash right there. And then switching over, we can also take a look at the exact same graph, but switch over to market weight. So this is what the actual weight of my portfolio looks like in terms of the actual market weight, which is more representative of where the returns are likely to move, obviously going forward, because that's just where the current weight is. So this, you can see kind of small changes between the two, that if you're weighting by market weight, we actually have a little bit more cash. Some of the other positions become smaller as they've decreased in their portfolio value. Some of them move upward with appreciation. So that's going to do it with our quarterly market update, and also finishes up our 2022 overall annual returns update. Looking forward to 2023. I can't wait to do more valuations, and I hope you're all there to see them all. Make sure you like the video before you go, and make sure you subscribe to the channel. That way you get notifications whenever I go live in said valuations in the future. And also, if you're interested, catch the link in the description to join our Discord server and join the discussion there.